Hi, everyone. This is Jason Burack of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today, instead of doing a normal guest interview where I ask questions and then go back and forth in a discussion, Mo Dawoud and I just want to have a general commentary and discussion about what we're seeing going on in the markets right now, because we think it's important for our listeners to understand, what we see. Our last discussion, Mo, where we didn't do an interview and we just discussed the markets, we talked about how one of the obvious signs that the markets were manipulated was that there was no volatility. But now, that the sell in May, go away, come back after Labor Day crowd, those traders have come back from their vacations in the Hamptons and all over the world and stuff. They've come back onto Wall Street, and we've started to finally see that volatility come back into the markets.
Yeah, ever since mid-September, which around the time we did our last Market Wrap podcast, the Dow Jones had topped almost 17,200, and now in just about a month, it went down over 1,000 points. So now it's hovering around 16,380 right now, and it was at one point briefly below 16,000. So in pretty much in over 1 month, we saw a lot of volatility and a big drop in the market, especially the Dow Jones and the S&P. So we're finally starting to see the volatility that is needed for the market, and a lot of it has to do with the QE3 program that's been tapered over the past year. And I think a lot of the Feds right now are starting to rethink their strategy, and even one of the Fed Governor Bullard is rethinking about pulling a plug on QE and maybe perhaps doing another QE, a QE4. And I think that might happen in the future if the market drop any lower, because the Federal Reserve and the government, they need the tax revenue, and with the wealth effect, they need the stock market to go up. And with the stock market going up and also the oil prices going down, the tax revenue is going down as well. So I don't think the government would want to see that right now.
Those are good points, Mo, and that's something that Jim Rickards also brought up on the interviews that we've done with him, is that at the end of each quantitative easing program before QE1 and QE2, every time the Fed ended those programs, the stock market threw a taper tantrum, and there was a 10% correction or more at the end of those, and then the Fed panicked about the markets, going below support levels and potentially crashing again like in 2008, and the market, and the Federal Reserve then reversed course and then put quantitative easing back into the program, back into the markets, flooding the markets with liquidity again. But I think, Mo, we're at the stage here where they can't really permanently take the liquidity out because of the derivatives markets and all the market manipulations that they're doing in the currency markets and bond markets and things like that. And it's just really amazing to me that we have people that are predicting, everything's going to crash again. Okay, well, maybe everything is going to crash again, but rationally, Mo, we should have crashed a long time ago. Without the Fed and the other global central banks printing money, we should have crashed a long time ago. Without, the cheap debt that the corporations have to buy back shares and boost earnings, these stocks should not be as high as they are. The Fed is causing the Fed and other central banks are causing humongous unintended consequences here, where people cannot live off of money in the money market or treasury market or even regular bonds and things like that, and they force them into the risk curve, into yield plays like general stock market and junk bonds and other, things that normal savers, older, more conservative investors would not normally have invested in the past. Even 8 years ago, they could have gotten 5 or 6% on a treasury, and now, they basically can't get anything on it anymore. That's the way it seems like we're headed with the 10-year note, Mo, just being slashed drastically. Recently here, the yield just dropping like a rock. So it's really just amazing that, we're starting to see volatility. That's what we see in normal, healthy markets, but these markets, Mo, are definitely not normal and healthy. There's still an enormous amount of intervention in there. I want to remind our listeners, though, I think this is very important, and this is something that we could definitely help them out with in terms of paid consulting work. This is what we talk about with our clients and educate them on. whether they know a lot about markets and, there's a couple extra points we can provide, or they're just getting started here, learning to manage their own money or manage their own ETFs and things like that, and that's risk control. So, Mo, if you're a professional investor or a professional trader here, obviously you still have some long positions here, although there's some traders that are taking all their money out, which I don't agree with. But, what types of risk control options do people have?
One of them is to have cash on the sideline during when we have volatility in the market like we're having right now, because a lot of these stocks that you may have wanted in the past, but you couldn't get it because it was too expensive, you can get it now, and it's cheaper now. So pretty much we're having a sell, so to speak, on all the stocks. It's like going to Macy's and you see your favorite sweater that you wanted. Now it's 50% off. You go see at your favorite stock that you wanted, and now it's like 30-40% cheaper than it was a couple months ago. So one of the ways to manage risk is to have cash parked on the sideline so you could take advantage of this situation. Another way is to hedge your positions using options. You can put options or various option strategies out there that you could use to protect your position, so you don't have to sell out everything and pay the capital gain or the short-term 30% taxes to the IRS. So there's many ways that you could tackle this by managing your risk, and also try not to have all your money, obviously, in one egg basket. So try not to have everything in one stock, one or two stocks. If if you have $50,000 or $100,000 in your portfolio, try to spread it out so that you're protected in case the market goes down like we're seeing right now.
Yeah, those are all good points, Mo, about cash. I think one thing that people talk about when hedging is they don't mention cash enough. I think cash is a really good hedge. Obviously, you're going to get devalued in the short term. So if you hold cash, decent amount of cash in your portfolio, 10 or 20% cash or something like that, for a year or two, you're going to get devalued by the global central banks, 8-10% or whatever the real inflation rate. We can argue what the real inflation rate is. But if there's opportunities out there, you want to be able to have the cash to go in and buy a profitable company or a company about to become profitable that it goes on sale a lot. So our listeners, hopefully, they've taken heed with this. We mentioned this in the past. But in terms of the market and what it can do here, I mean, you have people out there like Bob Prechter. I think I heard in one of his latest newsletters, he's saying that this is as high as the market will ever go. So those were full all-time peaks for the high of the market. It will never go higher than that. I mean, when you're devaluing the currency, Mo, you can go a lot higher than that. So as long as they can keep flooding the markets with cheap credit and devalued currency and keep pumping that in with the currency swaps and quantitative easing programs, global QE and all this other stuff, the asset prices can go a lot higher rationally than people think. Now, rationally, like I said, the market should have crashed a long time ago based on fundamentals, Mo, but it hasn't. But we may have a larger correction, but and I'm sticking with this call here, and I've been repeating this a lot in interviews, that rationally the stock market should have already crashed, like I said, based on fundamentals. But if we do keep going lower here, Mo, it's not going to be allowed for more than 6 months or 12 months to have any kind of meaningful stock market correction before the Federal Reserve or other global central banks just start flooding the asset markets again with more and more cheap liquidity, even larger quantitative easing programs or things like that to boost the asset markets up. This goes back to our last podcast too, where we talked about the problems with incentives and the incentive structure, Mo, that is in place for politicians and central bankers and Wall Street bankers and investment bankers and hedge fund managers is there's no negative incentives now, no disincentives for these guys to not print up all this money and prop up the asset markets, really. I mean, these guys are not, if they print up that much money, they won't get voted out of office. They're not going to be sued and things like that. If they didn't print up the money, they would be voted out of office. They would get sued. There would be, a whole bunch of other ramifications. So there's perverse incentives right now, Mo, in place where basically for them to maintain their careers and get all these bonuses if they're working in the private sector, hedge funds and things like that, for them to lobby for more money printing and things like that, and for politicians, for them to go along and accept more money printing because they get to do their spending programs, and, down the line, they when their political careers are over, the regular people on Main Street, people like you and me, Mo, we're going to get stuck with the bill for all this profligate spending and money printing and cheap credit and things like that these politicians right now are using to maintain the status quo and stay in office.
All right, you make a good point. I mean, if people think about it, I mean, there's no one regulating the Federal Reserve or any of the other central banks all over the world. They're pretty much on top of the world, and they have a lot of power in terms of in what direction the stock market can go. And so, yeah, the incentive there is not properly structured for a healthy economy right now. And it won't be for a while until we have a total collapse in the economy. And hopefully people will wake up and realize what the Federal Reserve had done to the economy and to the people on Main Street who are struggling right now to pay their bills because of high inflation and also struggling to find a full-time job right now. So I agree with you there. So if you look at the volatility in the stock market and you look at a lot of these stocks out there that people wanted, like, for example, ExxonMobil, I mean, the yield right now is 3%, the dividend yield. So that's better than what you get in a 10-year Treasury bond. So for all those investors out there that's hungry for yield, this is a great time to be looking in the stock market and adding to your position or start investing, because at 3%, I mean, that's better than the Treasury bond yield, and also it'll be a good inflation hedge for your portfolio as well. So
yeah, I think I don't hear a lot of other people in the alternative media mention enough about how good oil and natural gas over the long term are inflation hedges. There's a lot of benefits to oil and gas producers that have advantages over gold and silver miners, Mo. And I'm not talking about the royalty and streaming companies. Those are super efficient business models. I'm talking the actual mining companies, mining gold and silver and copper and things like that. An oil and gas company, they can be in production a lot faster than these miners can. They can. A lot of them are efficient at hedging production or turning production off and things like that. And, one of the other great things about oil and gas and why it's a good inflation hedge, too, is it's like food. It's consumed very quickly. So it's once you start burning oil or natural gas hydrocarbons, it's not recyclable. So it has to be reordered, and we're in order to maintain the type of modern global economy we have now, it requires a high amount of energy to do this. And yes, the developed world, the United States and Europe and Japan are using less fuel, and they're using more fuel-efficient cars and things like that. But there's more people on the planet as of now, unless, this Ebola thing goes completely, exponential and starts, destroying the planet, the population on the planet. I mean, I'm not an expert at Ebola, so I don't really want to fully comment on it. I'll leave it to more of the medical experts and things like that, what could potentially happen to it if it does. But based on what we see going forward, there's going to be more people on the planet, at least as of now. There's going to be more middle class on the planet going forward, coming from the developing world, coming from Asia, the Middle East, South America, Africa, those types of continents. And, they're going to want either they have their own motor scooter now, or they've chipped in with their family or their village and they're buying their first car. And, once they put in that money and they buy their first car, they don't want to go back. They don't want to go back to the lifestyle they had. They want a more efficient lifestyle, more productive lifestyle, where they're not doing necessarily as much manual labor because, they've been doing manual labor for a long time, and it's just not as efficient once you have a car and all these other luxuries and things with electricity and electronics and things like that. So I think food and energy, Mo, it's a good point, are great inflation hedges. We're seeing Warren Buffett buy a ton of inflation hedges. The mainstream media doesn't want to label it that. A lot of other value investors, we had Vitaly Katsanelson on, he didn't want to admit that Warren Buffett is buying hardcore inflation hedges now. So, he's been buying Suncor, he bought ExxonMobil, he bought the railroads, he bought his railroad to move physical commodities, and also he's buying John Deere, which is obviously another commodity play mode because John Deere helps increase crop yields for food.
Yep, and that's a great point. And also, people should realize is that the U.S. dollar is also rising, and that's because the ECB is about to or currently going to roll out their own version of QE, and also we got Japan still doing their QE program at $100 billion or so per month. So, and right now we have the Federal Reserve on the sideline not doing anything, and so that's what's hurting the stock market and making the U.S. dollar go up. And there's a lot of the speculation position on the U.S. dollar is very big right now, and it's because of this. It's because of the Federal Reserve not doing anything right now compared to the other countries around the world. And also, in result of that, we're seeing a fire sale in the commodities sector and agriculture as well. If you look at palladium, palladium since August has went from 900 to about hovering around 750. And also, if you look at platinum in the summer was at around 1500. Now it's hovering around 1250. And also, for people out there looking at gold and silver, silver is around $17 and gold around 1200.
Well, Mo, I think that's more than a strong dollar. We're actually that segues into our next segment. Besides the fact that you're talking about how, these central banks are coordinating and taking turns. So the Fed was doing a lot of the heavy printing and stuff for a while, and now, like, Europe, the euro got too strong, and the European exporters probably bitched to the European politicians, and the European central bankers lobbied to them and bitched to them and said, our currency is too strong, we can't compete, we need a weaker currency to boost our exports. And same thing happened, in Japan. The yen was getting too strong earlier in the year, and now the yen's collapsing again. The yen's back to enormous move in the yen. And these guys, like, they all take turns and they're coordinating things, and there's a lot of stuff going on behind the scenes, but they're doing things right out of the same Keynesian playbook, which is mercantilism, which is like the best way to get your economy going is to devalue your currency in order to boost exports. But the U.S. doesn't export a humongous amount, Mo. What we import a lot, we consume. Most of our economy is based along, government spending, consumer spending, and things like that. So we're just going to end up, even though the dollar's strong for now, I mean, the U.S. exporters are going to bitch too. They're going to say the dollar is getting too strong, we're uncompetitive, and then, the currency wars are going to switch back. And it's just going to be musical chairs, hot potato, whatever analogy you want to use, and it's going to really piss people off. I was talking with a currency trader, this guy I met at the gym, and he got crushed because he thought the euro would remain strong. And I told him, about the currency wars in Jim Rickards' book and how these guys are taking turns. And, he was in shock that he was like, really, they're sitting behind things doing all these coordination. I was like, yep. And he was like, well, how come the charts aren't reflecting this? And I was like, because they, do policy decisions when the markets are closed, and then they try to set off the moves and paint charts and blow out stops and things like that. There's central banks trading in the markets now, Mo. They're getting a discount, especially in gold and silver markets and other things. God knows what other markets these central banks are trading in now. They may be trading in all the markets for all we know, right?
Right, that is right.
Yeah, so that with central banks and things like that, that takes us to our next topic. We wanted to talk about financial warfare. Jim Rickards talked about this briefly in our interview that I did with him a couple weeks ago. The financial warfare thing, Mo, let's set some background. The U.S. has precedence for doing financial warfare with the Soviet Union. There's a documentary out talked about in past interviews called Houston, We Have a Problem. There's also a book out called The Oil Card that talks about this, and there's also other books out from retired oil executives, too, that worked during Ronald Reagan's administration that says how officials in the U.S. government from the State Department and the U.S. Treasury Department under Reagan said they wanted to put the nail in the coffin for the Soviet Union because obviously, central planning and communism and socialism doesn't work in the long term, but the way the U.S. finished off the Soviet Union was they took on too much debt when the oil price was high, when it went from $10 a barrel to $30 a barrel during the 70s, and then the U.S. set the trap for the Soviet Union. They got the Saudis to start producing a lot more oil at that higher price. The U.S. brought on more oil production, too, from I believe Alaska and also deep water in the Gulf of Mexico, and the Russians saw the high oil price, took on the debt, and then the U.S. collapsed the oil price and basically put the Soviet Union out of business in fairly short order. So I think we're seeing some of that financial warfare again. You mentioned the platinum and palladium price, Mo. Also, the oil price is down a lot in the last month or so. The platinum and palladium price are down a lot. I believe the agricultural commodities have taken a hit. I think this is repercussions for Russia, Saudi Arabia, OPEC potentially doing deals, outside of the dollar and the petrodollar, doing these bilateral trade agreements and settling, in other currencies out of the dollar. Although there's another good article from Robert Rapier, who we've also had on, saying he thinks the Saudis are forcing oil prices down. They're manipulating the oil market down, but the Saudis haven't increased oil production. They've been decreasing oil production. So I don't know, maybe they've hired Wall Street people to manipulate the oil price lower on the paper market, but I don't think that theory is as plausible as ours, because the Saudis need more money, right, to for their budget.
Yeah, I mean, for the government in Saudi Arabia, all of it, most of it, I think 90% of it comes from the oil revenues. So when oil prices go down, that means they can't meet their promises to the people in Saudi Arabia, because a lot of them, I mean, Saudi Arabia is a poor country. A lot of them depend on the social program that they provide. So, oil prices this low, I don't think they're happy about that.
Yeah, I mean, the Saudis can clearly survive, at least for a while, at these prices. The rumor, and Robert Rapier said this in his article, it's on Financial Sense, and also it's on Financial Sense if our listeners want to go look it up. But it's there for free. But what basically he was saying is some insiders are reporting, some mainstream financial news organizations are reporting the Saudis are okay with oil prices around these levels for the next 2 years, because they think that they can bankrupt a lot of the U.S. shale oil producers who have so much debt and higher production costs, right? I mean, even when the oil prices were higher, Mo, a couple months ago, a lot of the shale oil producers, they were taking on so much debt to drill and grow revenues, they weren't generating humongous earnings, they weren't generating free cash flow. They were reinvesting in their business, but it's a marginal type of unconventional oil production, and it has to be routinely drilled. So, I mean, in order for the oil market to meet, for supply to meet demand, we have to have shale oil production right now, because there's been huge declines in conventional oil production. So I don't think any of this is sustainable right now over the long term in the oil market in terms of supply, demand, and the price, unless we just see, demand fall off a cliff, or someone comes out with an amazing new discovery that's low cost. But, we haven't seen production costs drastically drop in the shale oil right now. But I think this is financial warfare, Mo. I don't know about you, but I think this is financial warfare from Wall Street doing the bidding of the U.S. government, where, Russia is now viewed as an enemy, especially with platinum and palladium being hit so much too. And then also, to penalize OPEC and Saudi Arabia. But these guys are going to retaliate. We're going to see probably, Mo, like in the next 6 months or a year, if oil prices don't strengthen up, we're going to see the OPEC, since OPEC still controls, 30% of the market, the total oil market, right? We're still going to see, I think, production cuts from OPEC announced soon. More of them.
Yeah, and I agree. I think this is a part of the financial warfare that the U.S. government is playing against Russia and Saudi Arabia and all the other countries overseas, in retaliation to their bilateral agreements and other trade agreements that they made. Like Russia made an agreement in Iran to trade oil going outside the petrodollar system, and also Russia and China and Russia and India and all these other countries are making trade agreements without using the dollar, and I think this is a retaliation, as you said, by the U.S. government to punish Russia for what they're doing. So, sticking on the topic of oil, now you said on Twitter this past week that the oil market right now and the oil stock is as cheap as it has been since 2009. So, right now, if investors want to buy oil stock, this is the best time to do it because it hasn't been this cheap since 2009. You want to elaborate on that?
Sure. Well, I think this is the best time to buy oil stocks since 2009. Given that oil is an inflation hedge, given the supply and demand that we see in the world. I mean, we see all this geopolitical problems in Iraq and in these other countries, and yet the oil price drops like a rock. So, yes, China has slowed down, but given geopolitical tensions, given that Actually, let me just first lay out the supply-demand argument for oil and why I see over the long term, unless we come up with viable alternatives, the oil price should, over the long term, continue to go higher. The BP, British Petroleum, or whatever it's called now, BP Initial, releases every year the statistical review, which is considered probably the most in-depth study of the world every year for oil and other forms of energy supply and demand. And they did enormous analysis of supply. And what they said is that the production growth really, more than almost 85% of all the production growth, in the last 7 years for oil has come from the United States from shale oil deposits. So there's very limited production growth from national oil companies and private oil companies outside the U.S. So yes, Canada has grown oil production a little bit recently, Brazil a little bit recently. There's a few other countries that are smaller amounts that have grown it a little bit, but on the other hand, there's been decline rates, rapid ones, in larger major conventional oil fields like Cantarell in Mexico, the North Sea, and Ghawar in Saudi Arabia. Iraq was on pace, to start drastically increasing oil production, but then ISIS and all this other stuff happened, and that's not going to happen now. So the hope now, I think, for people, besides the shale oil boom here in the U.S., is that the shale oil boom will spread to other countries, but there's not the infrastructure in place for it to spread rapidly to other countries. It's going to take, from what I've read from other oil analysts, it's going to take maybe 10 years, if not longer, for shale oil to really catch on in other countries. Might not even be as good, anywhere near as good. The U.S. just has better oil entrepreneurs and better oil experts and engineers and things like that. Now, maybe eventually we can move some of those guys, or there'll be the profit motive for them to go outside the country, go to those other areas, but it's not going to happen anytime soon. In the meantime, you're going to have decline rates. So we have rising capex here just to keep the oil production globally essentially flat. The capex is going up like crazy, and the production costs for oil were rising over 8% per year for a decade. And maybe if they drastically turn off production if oil prices stay low, that trend will temporarily stop. But I just don't see it over the long term that happening unless we come up with a viable alternative to using as much oil as we do, or switching to natural gas or things like that. But there's humongous issues with switching all the cars and things like that to natural gas, because natural gas is pressurized and there's more of it, and it requires pressurized tanks to store, and you're looking at redoing all the gas stations and redoing everyone's car engines from regular gasoline to CNG engines and things like that. So it's just the amount of money to transition quickly to switch over to things is going to be very expensive. So that's on the supply side. Demand side, from the BP statistical review, and yes, the people in the mainstream financial media are saying, oh, demand's dropping, China's weakening, but that's not what BP said earlier in the year. They said that global demand is still rising faster than global supply, and they see that trend continuing. We have a rising middle class, like I said, in Asia and China and India, in the Middle East, in Africa, in South America, and these have a rising middle-class consumer, and they're getting either their first motorbike or their first motorcycle, or they're getting their first small compact car for their family or their village, and they want to start, using oil and things like that to get and have a more productive and easier life. So once you buy a car, and people have been saving up because those other countries, they don't have easier access to credit like people do here in the U.S., so they've had to save their money in order to buy something like that. Once they've saved up for years to buy and make a purchase like that, they're probably not going to stop consumption then of oil and stuff like that for their new car. So I think that's still in place. But in terms of that's the supply-demand for the market. But I see bargains, really good, profitable oil and natural gas companies across the board. There's literally dozens of good ones that we could spend time talking about here on the podcast. Although, if we talked about dozens of them, we'd be giving away probably too much. Then people wouldn't hire us for paid consulting work. So we'll just...
Just give away a couple.
Sure. Well, first, let me just outline a little bit of the oil market. Some of the companies that are in the best bull market right now are the oil service companies. They have a company like Schlumberger, which is symbol SLB, Sally, Lisa, Brandon, that stock has gotten hit a lot. I think it's down 16% in the last 3 months. So it was a lot higher. It's close to a 52-week low. It's trading at around 18 times earnings now and about 14 times forward earnings projected. And the reason the forward earnings are probably fairly accurate, Mo, is that these oil service companies, the Halliburtons, the Schlumbergers, the Baker Hugheses, the Weatherfords, these oil service companies, they do a lot of the fracking, and they haul the water, and they case the pipes, the wells that are horizontally drilled and then fracked. They case them with cement, and steel and things like that. So they have stuff on their order book, some of these companies, Mo, for 10 years or more. So they have 10 years worth of orders going out from people who want to do fracking or other types of drill jobs. And normally every year, Mo, they get to raise the price. Because they say, if you want to stay in line and keep your order and stuff, our costs are going up. They have to pass it along to their consumer. That's pricing power. So you have companies like this that are really immensely profitable. And, Schlumberger has almost a 2% dividend yield now. It wasn't cheap before, but it's starting to get fairly cheap now. It's a good time to think about starting a position in a stock like that, or adding to a position in a stock like that. The oil service companies that are doing a lot of work here in the U.S. and Canada, they're really safe geopolitically. Schlumberger is diversified all over the globe, though. But there's good opportunities there. There's really good opportunities now in some of the MLPs, the commodity producers. These guys produce oil and gas, but they hedge. So some of them may hedge out the oil and natural gas price for years in advance in order to lock in a profit. So they can pay out for a master limited partnership. A company like Vanguard Natural Resources or Brightburn Energy are two of the larger ones other than Lynn Energy. Vanguard and Brightburn both have over 8% distributions, and they're profitable. Although, obviously with an MLP, there's different tax considerations for our listeners out there. It's not the same as a corporation. So we would talk about that more in a consulting session and other stuff and refer to that. There's going to be more tax consequences if you don't hold the position for a long time. But the yields are very attractive, and there's really good yields on the actual oil producers, whether you're here in the U.S. or up in Canada. You're a Canadian oil producer, there's really good yields on those. And there's also a lot of great yields on ones outside the U.S. too. So, I mean, there's just so many good, profitable oil companies, Mo, like basically 15, 20% on the more established, profitable oil companies. That's what was just lopped right off of these stocks in the last couple months. And some of the really good oil juniors that, are not as liquid, and maybe they have good exploration wells, or maybe they're bringing more production online or things like that. So they're transitioning from either not profitable to profitable, or a little bit profitable, and they're taking on more debt to drastically increase production, and they're still going to have good netbacks and things like that. So it just depends on people's risk tolerances and what kind of risk they want to take to make good gains in the market. But there's really good for a more conservative oil investor there who wants to destroy what they can get in bonds from a safe, profitable company. There's just so many good options out there in the oil market. And like we said earlier, it's a really good inflation hedge to diversify your portfolio out of accumulating physical metal for insurance purposes, or buying gold and silver, royalty and streaming companies and things like that.
Definitely, and it's definitely more inflation coming into the economy as we go further along, and we watch the Federal Reserve print the fiat currency out of thin air, and the value of our currency would approach zero over time. Just like any other fiat currency that were created in the past thousands of years that was backed by nothing. So you made a great point there, and it's a great time to invest in oil stocks. It's a great time to invest in other commodity stocks as well, such as gold and silver, which we've been covering extensively in our podcast for the past couple of years. The gold and silver prices so far this year have been not very good. No surprise for us. I don't think this year would have been a good year for gold and silver anyways, but I mean, a lot of miners right now are really struggling to hang on with the low prices because they were betting on higher prices a couple of years ago. Now they're paying the prices. So just have to watch out and see how management is trying to stay afloat and how they're trying to move forward and see, look at the business model and look at the mind and see how they're producing and look at the cash flow as well.
Yeah, people have to look at how much cash. They have to know if they can't do it on themselves, they have to learn either the accounting skills to how to read a balance sheet, the basic accounting skills, or they have to have a newsletter or someone teach them how to do this. They're going to manage their own money, or they can buy an ETF like the new Sprott Gold Mining ETF. Has a lot of good companies in it that are well diversified that have better balance sheets in the gold and silver mining industry. But we're starting to see, Mo, like the last-ditch effects of the final bottom for gold and silver, because you're starting to see mining companies now go bankrupt, and you're starting to see even the really large, well-run, low-cost producers like First Majestic Silver. Did you see the press release earlier in the week, Mo, that said First Majestic Silver is holding 35% of its silver production, is not selling it, just put it in inventory. So once we start seeing more of those companies do that, and we start seeing more of the inefficient, higher-cost producers either go bankrupt or put mines on care and maintenance, or sell out the company for pennies to a larger company. Once we see all these things, that'll be like the final bottom here. We're working our way out. I mean, obviously we could go lower in the paper price, but there's real physical limitations to that in the real world, in reality, for supply and demand. And that's something we spoke about with Eric Sprott and Rick Roll, who, by the way, I really, if people want a really safe, conservative way to play gold and silver's rise going forward, it's Sprott Inc. It's on the TSX. It's SII, Sally Israel, on the TSX exchange, Toronto Stock Exchange. Over the counter, I'm not sure what the symbol is off the top of my head, but Sprott will pick out, they're doing the deals then to pick out your gold and silver mining stocks, so they have positions in those. They finance miners, ones that have good projects and good balance sheets, so they're sending out their geologists, their metallurgists, they're having their finance people look over the balance sheet and stuff and do background checks on management to check track records. So that stock has, I believe, a 5% dividend yield. It's at a 52. It's routinely making 52%, 52-week lows. 5% dividend yield, no debt, and I think over $300 million cash on the balance sheet. So it's still profitable now, I believe. And when gold and silver prices go higher, they collect fees from the Sprott Physical Gold Trust, the Sprott Physical Silver Trust, the Sprott Physical Platinum and Palladium Trust. And they're also, like I said, they have warrants to the better gold and silver mining stocks. They do the due diligence. They have the private placements in the best mining companies. So obviously, like, the best chance at getting super high returns, Mo, if you're a really high-risk investor speculator, is if you do a private placement, right, and get warrants. But there's a lot of basically all the junior miners out there, Mo, looking for capital now. So when everyone's looking for capital, it's not exactly you have to know what you're doing to pick out the right companies. And I think that's why it's important that, if you don't know what you're doing, someone like Sprott can do the due diligence for you and pick out more winners than losers, and you're getting paid a much better yield than even a treasury account bond with huge gold and silver upside when the cyclical bear market ends and we finally break this manipulation in the paper markets and things turn.
Yeah, and a month ago we went to Toronto and met the management for Sprott and Sprott Resources and Sprott Inc. And they're very smart and they know what they're doing. And they have a good track record. So people want yield, and Sprott Inc. is a good choice, as you just mentioned.
Yeah, I was about to actually, for full disclosure, I'm probably going to buy some Sprott Inc. this week. I think it's a really solid play here. It's very conservative. And it also has good upside, too, as the market fully recovered. And, they're doing deals right now. They have the debt from good gold and silver miners and other resource miners. They do extensive research on it, so they have a good yield portfolio in bonds for miners. They also have equity for miners from private placements at good deals, and they have warrants. from those private placements too. So there's a lot of optionality there in Sprott that I don't think the market fully understands. And the best part of that optionality is they're not doing it with a humongously leveraged balance sheet. They're not taking on enormous amounts of debt on the balance sheet. They have a large amount of cash on the balance sheet, and they're paying out a good dividend. So I think it's a fairly conservatively run company, considering they're not leveraged to the hilt like a lot of other banks are, and it's a good yield play. Plus it's gold and silver play, and it has good upside. So besides the gold and silver royalty and streaming companies, which we love, I think Sprott is a very safe investment here over the long term. And I'm looking to add more yield to my portfolio. So I'm looking for good oil options and natural gas options. And, there's different types, whether it's MLPs or oil and gas producers or oil service companies or deepwater offshore companies, that the market is just panicking, thinking there's going to be lower oil prices. But, you and me, Mo, could talk for hours. Because we've researched the oil market extensively. We wrote our Petro Profit Report in 2012. There's a lot of reasons why a really low oil price is not sustainable given supply and demand and all these other things. So I think what has happened is financial warfare. The Russians, Jim Rickards brought this up in our interview, that the Russian government did plant a cybersecurity virus. They did plant a virus inside the NASDAQ to crash it. So it does, and then I've heard other stories of Chinese government things and Chinese corporations trying to hack American corporations and things like that. So there's both sides doing things, and there's Stuxnet, with the U.S. government doing that to Iran's nuclear program and things like that. Although it appears now, Mo, that the U.S. government may be, now that they're kind of distancing themselves from the Saudis, they're kind of cuddling up to Iran now because they think Iran can increase oil production or something. I don't know what to believe in terms of geopolitics. I mean, people can switch so quickly. But I think we're going to see more volatility going forward. We're going to see more financial warfare going forward, and I think it's important for our listeners to understand risk management and how to hold cash and hedge, and also be diversified with your inflation hedges. And you and me, Mo, just bought more metal too, so I think it's smart, especially these prices for physical silver. I think it's really smart to keep adding, but I don't view that as an investment though. That's just insurance for me at least.
Yep. Yeah, I just bought a big purchase of silver. I haven't got it yet. So definitely a great time to buy it at these prices that I don't think would ever happen again, but it happened, so I took advantage of it. So other side note that's going on with our company, right now our website is still down. We had a unfortunate incident with our server, so right now we're basically gonna have to recreate a new website. Will be better than ever than before. So hopefully we'll have that up within a month. So we'll keep people updated on that. But if people want to contact us, they can still go to our Twitter page, to our Facebook fan page, and also you can email us at Wall Street for Main Street at gmail.com. So before I close it out, Jason, do you have any other final thoughts?
Yeah, we just passed 400,000 views on our YouTube channel, so I really want to thank our listeners for that. If they can leave us 5-star reviews on our iTunes channel, I'd be very appreciative. I'm supposed to interview Patrick Byrne, the CEO of Overstock, Libertarian. Wall Street hates him really badly. And he was one of the first online retailers or major retailers to start accepting Bitcoin. I'm supposed to interview him this week. I'm getting my gum grafting surgery on Friday, so that's not going to be fun, but it is what it is. And we have our Indiegogo campaign up. We're looking for angel investors to pitch to really grow the company out. I think we have a really great business plan in place to install virtual classrooms. I don't want to go into our full business plan here, but if someone can refer us or is a potential someone with capital and wants to hear a growth plan, I think we have the next great investor education company that can completely change the way people learn how to invest in different asset classes and Austrian School Economics all in one place, efficiently and affordably from successful investors, and it'll be extremely disruptive to MBA programs, business programs, and things like that. People who still wanted the skills, but the piece of paper, the degree, might not even get them a job anymore. So I think we're really going to keep working on that, and we want to just keep cranking out good content. And if you have any other comments, you can email us, wallstreetformainstreet@gmail.com. But I really think, Mo, like, besides gold and silver, like, there's a lot of bargains in the resource industry. But the oil investments, because of the cash flow from them, how quickly they can cash flow, a lot faster than miners. And normally the oil industry CEOs are a lot more, better run, except for like the royalty and streaming company CEOs in gold and silver. But there's just so many bargains right now in oil. I didn't expect to see a 20% discount in oil. There's bargains across the board, whether it's, ExxonMobil or the oil service companies, the main ones I talked about. There's good mid-tier ones too, or even MLPs. So there's a lot of good bargains in oil that people should be buying now. Warren Buffett's buying oil and inflation hedges now, and I think that's the smart way to go long term.
Okay, great. Well, for people that want to listen to our other podcasts, they can go to our YouTube channel and check that out, as well as our iTunes channel. So thank you, everybody, for listening.